Hi, I'm Alison Pyle, a director within the charity and not-for-profit team here at Buzzacott. Today I'll be providing an overview on accounts preparation for academies. This session will cover year-end preparation, preparing statutory accounts, year-end analysis, examples for fund accounting and funds by school, financial statement disclosures, and we'll touch on the AAR information. So what does the overall process for preparing year-end statutory accounts to the 31st of August look like? And what are some of the details that you need to factor into that process? The considerations and the information that you'll need to collate in preparing for the year-end audit. We're going to start with some of the fundamentals in terms of preparing the accounts and outline the key steps that are required. So firstly, it goes without saying that all of the transactions for the year should be recorded within your accounting system. So that includes all of your income and expenditure. In addition, you'll need to capture any necessary information from the post-year-end period. So particularly when you're looking at accruals, you'll need to identify any invoices that are coming through post-year-end in order to give clarity to that year-end position. But there will also be, within your system, some year-end adjustments that might not be entered into the ledger on a monthly basis for the purpose of management accounts and management reporting purposes. So we'll cover a number of those today as well. Secondly, in terms of the trial balance that comes from the accounting system, you'll need to make sure that it is fully reconciled and that you understand the balances and transactions that sit within there. So this means ensuring that your bank reconciliation and your year-end reconciliations of control accounts, so things like payroll, VAT, the purchase ledger, for example, have all been undertaken and fully reconciled and agreed with any differences investigated. The next main step is then mapping the TB to the statutory accounts format. Our Excel workbook helps with that exercise, and you can find another video on our website which explores that in more detail. The key here is consistency in the mapping with the prior year, so understanding where all of your TB codes are being reported through. We would expect the mapping to be consistent year on year, particularly the categorisation for your income and expenditure reporting. That is, unless there are any specific changes stemming from the ESFA's annual accounts direction, which require you to change the mapping. It's worth, at this point, also doing a sense check back to the management accounts. So considering whether the overall movement in funds being reported within the statutory accounts makes sense and ties back to the operational position that your management accounts were reporting at the year end. Undertaking this reconciliation exercise really helps to understand any potential late adjustments related to operations, for example accruals, but also some of the other year-end adjustments. So for example, in respect to pension accounting and maybe some of the capital side of things as well. The next step is to consider what additional schedules are required both for the audit visit and also for the accounts disclosures. So make sure you are aware of the disclosures that are required within the accounts and the information pack that you're providing and pulling together at the year end, and making sure all of those requirements are covered. And I'll go into these in a little bit more detail. But for example, if you have accruals or prepayments, make sure that there's a clear listing of what those are at the year end, and particularly the more material items. There are also the narrative reports that need to be included within the statutory accounts. So this is the trustees report and the governance statement. You'll need to pull together all of the information. So for example, the governance statement requires details of meeting attendance for the year. So you may need to get others involved in gathering some of the information, so the clerk or the director of governance, for example. And then just a point on the ethical standards. So as auditors, we are able to provide support in respect to the accounts preparation exercise, but we have to be mindful of the ethical standards and the necessary safeguards that we need to put in place. I want to emphasise here that the ownership for that accounts prep is with the Academy Trust. Ultimately, the trustees have responsibility for those accounts. And although we will, of course, aid you along the way, responsibility must rest with the trust, and we'll need to see evidence of that through the process and the review process. So the second area we're going to cover is the year-end reporting, the areas that you'll need to consider, and the overall core financial reporting. The key to these areas that we're going to run through is that they are all addressed in good time, and any issues or queries are flagged to your audit team in good time to allow for a smooth process. Probably the very first thing you need to do is check that your opening balances in your ledger definitely tally back to last year's final signed accounts. If there are differences in the opening position, there'll be differences at the year end and the accounts won't balance. So make absolutely sure that that step is checked off. As I mentioned earlier, It's key that your control account reconciliations are all reviewed and the reconciliations are undertaken at year end. Hopefully that's been a monthly ongoing process throughout the year. So really at year end, this should just be like any other month. So the bank, VAT, debtors, payroll, and any other control accounts that you have sitting within the balance sheet as well. The next task is making sure that you've got a full review and listing of accruals and prepayments so that this is available for us as auditors and also for any provisions as well. So again, these may include items that are just adjustments made at year end. This might include, for example, holiday pay accruals or any HR-related provisions or any legal provision. For example, if there is an ongoing dispute, really revisiting the value of that or introducing a new provision onto the balance sheet at the year end. Next, we're going to look at the various sorts of elements of income that you receive. For a number of trusts and schools, you'll have school funds and governors' funds, and you'll need to consider the income and expenditure relating to these. Sometimes for newer multi-academy trusts or newer trusts, the governors' funds have been kept separately outside of the accounting system. So you'll need to make sure that you're capturing everything that's under the control of the trust and look at how they're accounted for. Typically, this will be coming in as unrestricted income, but potentially some elements of donations may need to be captured as restricted. You'll also have trip income and grant income, and we'll come on to more grants and funds a little bit later. But it's really important to be clear around the purposes for which you're receiving income in the year and also the allocation of costs to each of those pots of money as well. The next area to consider is fixed assets. So the capital funds are ring-fenced within a set of Academy Trust accounts. So there's quite a considerable amount of work to do in terms of reviewing the capital spend in the year and also looking at how capital purchases have been funded. So have you funded that from your capital grants or is it coming from your own reserves? Considering how that's reflected within the accounts and also looking at the fixed asset register to substantiate the values on the accounts and the fixed assets. In terms of the fixed asset register, you need to make sure that your fixed assets within your asset register agree to the balances in your accounts, so reconciling the two and understanding any differences. Also, it's good to check the opening position. If there are discrepancies from the prior year that haven't been resolved, then gaps between the two can grow and develop. You will also need to consider transactions on fixed assets on the introduction of new schools, so making sure that those are reflected in the asset register. And obviously any additions, disposals and depreciation charges. And finally, looking at whether what you have spent in year is capital or revenue. A lot of trusts do this assessment throughout the year and others choose to review it as part of the exercise over the summer. You'll also need to think about how capital funding has been used and reconcile any unspent balances of capital funds at the year end. Next, you've got the local government pension scheme valuation. So this is the actuary's valuation of your share or the individual school's share of the relevant local government pension schemes. Typically in the past, that's been a liability that's appeared on the balance sheet and the annual movement is reflected within the accounts. Recently, we're seeing more surpluses on those schemes, so they're in a net asset position. The degree to which that asset is recognised on your balance sheet needs to be considered. The likelihood is that for most trusts, the scheme will be capped at a nil balance, so you wouldn't be recognising the asset because it's not deemed to be recoverable. There is some scope for recognising an element of the surplus, so it is worth discussing once you get your actuary valuation statement through. The key in the preparation is liaising with the pension scheme actuary to ensure that the report, or reports if you're in multiple schemes, are delivered in time to be factored into the accounts preparation. Another critical area for the accounts preparation is the fund analysis, and I'll go into this in a little bit more detail now. To summarise, it's key that there is clarity around the funding coming in and the key funding streams and the amount that's been spent in year and matched to those funding streams. And what are the unspent balances on those funds at the year end? For multi-academy trusts, you also need to consider the schools coming into the trust and any schools departing the trust and how that impacts on the funds transferred in or out of the trust. It's key that the fund analysis is considered at an early point in the accounts preparation exercise. So, looking at the fund accounting in more detail, this is absolutely crucial to the core of the financial statements. So on screen, you can see a replica of the fund note that comes from the Academy Accounts Direction itself. This is a more detailed breakdown of the income and expenditure and the balances against each funding stream. It's more detailed breakdown than anywhere else you'll see within the financial statements. You must ensure that the subtotals within this note tally to the other statements. So for example, against restricted general funds, you have income there of 4.882 million. That must tally to the total income on your restricted general funds within the statement of financial activities. Similarly, the total of expenditure and the gains, losses and transfers figures all need to tally to the statement of financial activities. This also applies to the balance sheet at the year end, so make sure that all of the key figures, the subtotals in this note, tie into the balance sheet. For example, the pension reserve you can see here, you have a negative 1.413 million. That should be the same balance as the liability for the pension on the balance sheet. The key to this note is looking at the individual income streams. You have your brought forward unspent balances from last year as the opening balances. And then you have your income that's come in against each of the defined funding streams. And then you look at the allocation of expenditure to each of those. A lot of it will be pretty straightforward. So for example, the pensions will be linked to the pension, i.e. the actuary's report. The fixed asset fund is predominantly the depreciation charges. However, you will then have your operational spend to look at in terms of allocating that against, for example, within the restricted general funds, how much goes against pupil premium, how much goes against the GAG, the general annual grant, for example. So start with those funding streams that have the most narrow restrictions on them, allocate the costs to those, and then work to the more broader funding streams, as the general annual grant can obviously fund a number of educational purposes and the broader educational spend of the Academy Trust. But really that funds note is really worth thinking about at an early stage because it does sit at the core of the accounts, even though the note is actually found towards the end of the accounts. For multi-academy trusts, there is also the requirement to split these funds separately by school, and you can see an example on the screen. So what you have here is your total funds, the 9.4 million. You don't have to split the pension reserve by school, so that's the total pension reserve, the 1.4 million. You then have your total fixed asset fund, and then your operational funds, which is the 742,000. You have to split that between individual schools and the central office where relevant. So ensure that that 742,000 does tally to your unrestricted funds plus your restricted general funds and is broken down by school as presented here. The next area I want to cover is a reminder on the numerous financial statements disclosures requirements that are in addition to the core statement of financial activities and the balance sheet. The ESFA and various reporting regulations, such as the Charity Statement of Recommended Practice, require you to disclose many further specific transactions and commitments and liabilities. So you need to understand what the required disclosures are and ensure that you have the necessary information ready for inclusion in the accounts. These disclosures are updated each year via the Academy Accounts Direction, but it's really pretty stable and doesn't change much year on year. So on the disclosures, firstly, the SFA requirements around specific items that of spend in the year that you're required to disclose. So this includes things like losses, severance payments, debt write-offs, land and building disposals, for example. So be really clear on the requirements there. You'll need a summary of these individual amounts that the Trust has transacted in the year. Funds we've already covered earlier, but note the narrative requirements here too. If you have a school that has a deficit level of operational reserves, for example, you'll need to disclose why that is and what you're doing to address it. Worth noting on expenditure allocations, within the statement of financial activities under expenditure, it's likely that for most trusts you'll just have one core heading, which is educational operations. However, some trusts may have more than one heading. You may have a teaching school hub, or you may have boarding activities, or you may have costs of raising funds. If you do have any of those three items, you'll need to look at how the support costs, so your core overheads, are allocated to each of those expenditure headings. It is likely that they'll be relatively minimal in terms of the raising funds or the teaching school or the boarding, and still the bulk of support costs will be going to educational operations, but nevertheless that allocation is a requirement. Another required disclosure is capital commitments. So this would include anything that you've committed to that's not included yet in your capital spend. So where you've signed a contract, for example, at year end, that will need to be disclosed in the notes to the accounts. Related party transactions, make sure that you have the declarations of interests, that those are all up to date, and that you know of any transactions that need to be disclosed in the accounts. Operating leases, similarly there, anything like rental, photocopiers, etc. Audit fees, there are required disclosures on those, as well as for gains and losses on disposal of fixed assets. On deferred income, you'll need to include a narrative on the reasons why you're carrying forward some income within creditors. And then the pension disclosures tend to be 5 or 6 pages long, covering both the teacher's pension scheme, which is a standard disclosure, and then the LGPS, which comes from your actuary's report or reports if you have numerous reports. On agency arrangements, this is things such as the 16 to 19 bursary funding, where you're purely acting as an agent to pass on the funding to the pupils. The accounts direction covers this specifically, but you have a disclosure note around those transactions within the notes to the accounts. In terms of multi-academy trusts and the additional disclosures required for these, the central charging structure, you need to have that information ready, and the narrative around central services and how much each school has been charged in the year. In addition, the balances around schools that have left or have joined the trust during the financial year, further disclosures around those are required by the accounts direction. On staffing and trustee disclosures, these are quite lengthy. Many of them are driven by the ESFA requirements. So it's worth looking at these in advance of your preparation exercise because you're likely to require input from other teams, so the HR or personnel teams particularly. Just a couple of things to highlight here. Staff numbers for the accounts, the use of headcount is fine. FTEs, so full-time equivalents, is optional, but do check the AAR requirements, so the accounts return requirements, because FTE will be needed for that. On severance payments, any contractual statutory severance payments have to be disclosed in separate bandings, and that does also include anything that's non-statutory. Where there are non-statutory items, so special severance payments, those are disclosed individually by amount. So again, information you'll need there probably from your HR teams. Higher paid employees for the bandings, just make sure you're clear here whether pensions and national insurance are included or not. So for the bandings, employers' pension and national insurance contributions are excluded. For key management personnel, this is total remuneration. So it includes employers' pension and includes employers' national insurance. And then for the remuneration of trustees disclosure, this is, for example, if the CEO is also a trustee, it's the salary plus the employer's pension contribution. So each one of those disclosures is slightly different in requirements, so just make sure you're really clear on that. The final area to consider is the Academy accounts return. So this will require some additional information beyond what is needed for the statutory accounts. So for example, additional amounts around staffing disclosures, counterparty balances, for example, which is any transactions with other academy trusts, and benchmarking information by school for multi-academy trusts. The submission date for the AAR is usually the end of January, but we always encourage trusts to prepare for this pre-Christmas, so ideally as part of the main statutory accounts preparation exercise. It's much easier to gather some of the information at the same time, particularly if it rests with other teams. That was everything that I wanted to cover today. You may find it useful now to watch our video on the Excel accounts template workbook, which covers the statutory accounts preparation process in more detail.